Welcome to Close of Business. I'm Alicia Barry. Retailers are facing chaos as the clock ticks down on a tax exemption on low-cost goods entering the US. Some Australian businesses are choosing to halt all exports before it runs out at the end of the month. Australia Post is still investigating how it'll pay and collect the new duties. Amelia Turzon reports.
Lots of these packages were destined for the United States, but now they're going to be sent elsewhere.
We've decided to stop shipping to the US because we can't provide clarity to our customers. It's tough to make a decision, especially when it represents a third of your overall revenue.
The Australian fashion brand is making this call after the US president decided to end a long-running tax exemption for global retailers.
That was kind of the way that countries were able to still trade and not be subjected to huge tariffs for the end consumer.
Until now, goods going into the States worth $800 or less weren't taxed. This so-called de minimis exemption is being axed on August 29. Products will now get the tariff associated with their country of origin or a duty ranging from $80 to $200.
Look, I think the simple way to describe it is just utter chaos.
Apéro uses Australia's national carrier for its shipping, and its co-founder says they're struggling to get firm answers about what is happening next.
The lack of ability of even people like Australia Post to be able to address these issues in a timely manner puts us and all of Australian fashion, I think, in a really precarious position.
Australia Post didn't respond to specific questions. This tech company helps Australian retailers send goods to America. It's finding that because of US tariffs, some businesses on its platform are pulling back.
What we've kind of identified is that there's been around a 36% drop in volume since April in terms of outbound shipments from Australia to the US.
It's a navy blue large, olive green large as well? Yep.
This Australian brand makes its tops in China. It ships them directly to its distribution centre in America, meaning it's already being slugged with Trump's far higher tariffs on Chinese-made goods.
And so we're glued to, the ABC watching what's happening with these tariffs. It just got out of hand really quickly.
At the start of Donald Trump's second presidency, there was already a 10% tariff on Chinese goods. This was increased in February to curb imports of fentanyl, sparking retaliation from Beijing and an even higher tax rate in March. Then came Liberation Day and a tit-for-tat escalation, igniting a bigger trade war where the tariff rate reached 155%. That de-escalated significantly after officials met in Geneva and later London. Nashi's latest tariff bill was still in the six figures.
I was very salty when I was sitting in the Commonwealth Bank, paying that as an international transaction. There's no way you can possibly absorb that. You'd be selling almost at a loss.
I really feel for these businesses simply because they don't have any certainty whatsoever.
While the superpowers are in a trade truce until November, this trade expert doesn't think they'll firm up a deal by then.
Where we have tariffs at the moment is where they'll be for a little while, and probably through to next year at least. The uncertainty is almost as impactful as the tariffs themselves.
The Australian government says it's giving these stressed exporters $50 million in support and interest-free loans. But months after Liberation Day, they still haven't received this cash because it's yet to pass Cabinet. Apéro wants far more help from Australia's Trade Department.
We've never heard from Austrade, and it's quite crazy. I think there's a lot of labels and brands that do a lot of trade in the US, and we haven't heard a single thing from how to navigate this. It's all on our own.
Left to survive in a world where the global economic order is changing.
The three-day productivity talkfest wrapped up in Canberra this week, with the Treasurer praising the goodwill and good ideas of participants. While there was agreement on slugging EV owners with a road user tax, broader tax reform remains up in the air. Jim Chalmers hasn't ruled out a tax shake-up, singling out intergenerational inequality. But immediate changes to capital gains discounts and family trusts aren't on the table for now. The Grattan Institute CEO, Aruna Sathanapally, was there. Aruna Sathanapally, welcome to Close of Business.
Thanks for having me.
What did you make of the productivity roundtable that you were at?
Oh, I mean, it's pretty extraordinary to have that group of people gathered, to be in the cabinet room, and it's pretty extraordinary to be having a conversation about tax reform. It's a really hard discussion for governments to initiate, so it felt like a pretty special opportunity.
And speaking of hard, the Treasurer has acknowledged the intergenerational inequality in the tax system. I mean, you've done some research that points to that. The over 65s paying less tax than under 65s on the same salary or earnings.
That's right. So when you look at the data, the position of households who are earning the same amount of income, you can have quite different tax bills depending on whether you're working age or whether you're retired. And the reason for that is that earnings in retirement are tax-free, but that can lead to the consequence where you can have two households side by side. One is a working household on 100K, the other is a retiree household on 100K. The retiree household can pay less than half the amount of tax. So there's some pretty stark inequalities in our taxation system.
And what was proposed in these tax sessions in order to address this?
So what the Grattan Institute has proposed in the past is there's good reasons to have concessions in super. It's compulsory saving. We want people to save for their retirement. But there's a very strong case now that we can see in the data that we've over-egged it, that the concessions are excessive. They're doing more than they need to be. So winding back those concessions for super. And then the other piece of it is at the moment, when you hit retirement, you pay nothing in tax on your superannuation earnings, and so what we've proposed is a low rate of tax on those superannuation earnings. And while obviously that's a bit of a difficult thing to propose, we just need to grapple with the fact that the healthcare system, the aged care system, they're costing far more than they ever were before. That's only going to continue as the population gets older, and we really need to think about how to get the tax system to work for a smaller working age population and a larger retiree population.
Well, Jim Chalmers says the group that was brought together at the round table was not there to replace decisions taken by Cabinet, but merely to propose ideas that he will then take to Cabinet. I mean, how hard is it to sort of expect that the legislative ability that the government has will actually match the political will?
Yeah, look, I think that these are difficult questions, right? We haven't come to our answers easily. We've gone through the data, we've gone through the evidence, we've looked at what we think the future is going to look like. We can provide that information to the public, to government. There were people around the table who had time to digest those issues in advance, brought their own perspective, the union movement who can speak to how it's playing out in workplaces, the business from how it's playing out in their context. So I think one of the things the roundtable could do was to identify where there was that common ground and that sense of priority. And there was a real sense of priority on the idea that our tax system needs to work for younger Australians. And we can't just kick this into the too hard basket and just expect somebody else to solve it. And I think my sense was that there was an agreement around that, and that message was heard.
Well, your predecessor, Danielle Wood, earlier in the week said these reforms are much more complex to design and implement than the reforms that were taken in the 80s and 90s. You can only float the dollar once. This is hard stuff, isn't it?
Yeah, and we were just specifically talking about tax reform on the last day, but the broader roundtable was about all the reforms we have to boost productivity, to grow the economy in a way that lifts living standards. But she's right, some of those really big reforms that we've done already, we can't do them again. And now we're looking at a basket of lots of small reforms, but when you put them together, there's the potential to create something meaningful. One of the things that was talked about a lot was all the ways in which it's hard to do things in Australia because we've got so many jurisdictions for such a small population. So the opportunities to really streamline the experience of working and doing business in Australia is something that's still on the table.
Now, EV road user charges broadly agreed on as something that could be implemented fairly quickly. This is a bit of a quick political win, though, isn't it? Low-hanging fruit.
Yeah, it's interesting because on the one hand, it might seem fairly small. There still aren't that many electric vehicles on the roads. But the broader principle is an important one. So, as I said, Australia is a small small population on a very vast landmass. That means that we have more infrastructure per capita than other countries. So that's a bit of a drag for us in terms of our productivity. It means we have to think about using our assets as well as we can, getting the most out of them, and that includes our roads. If we price our roads such that people are paying for the damage that they're causing, say really heavy vehicles, and if we price our roads so that people can smooth when they use them, so to deal with congestion, getting people to use them at the times when they're less busy, we'll make better use of these very large public investments. So I think the principle of road user charging is a really important one. So it's good to see that the broad agreement around that.
Now, tackling superannuation tax concessions, as you've pointed to, and capital gains tax discounts and negative gearing, they're hard. What about making resources companies pay their fair share of tax?
One of the things that we've pointed to and that I mentioned in my speech is we need to think about how we are raising revenue on fossil fuels while they are still being exported. Now, this is a time-limited window. The longer we leave it, the more the chance we just miss the boat.
Have we missed it already?
I don't think we've missed it already, but we absolutely should get cracking. And the case in point is LNG or gas exports, hugely profitable, have raised very, very little tax. And you see the percentage of tax paid on profits has declined markedly. And in that particular tax. And part of the reason for that is that the tax was designed for oil, and now we're exporting gas. But really, that's an opportunity to make sure that Australia is getting its share of those resources, and really thinking about how we're going to pay for the damage being wrought by climate change, which is also going to hit Australia really hard.
Aruna Sathanapally, thank you.
Thank you.
Insurance is supposed to bring peace of mind, but copping a 600% premium hike has brought anything but for one consumer the ABC spoke to. It's just one story of many, as the big insurers report bumper profits thanks to years of premium increases and fewer natural disasters. Rihanna Whitton reports.
Michelle van der Laan Smith's home is her sanctuary, but insuring it has turned into a nightmare. Her premium was about $700, so when it jumped to more than $5,000, she thought it was a mistake.
I was shocked. The insurer basically justified the increase by saying that my property is a flood risk, and based on their national modelling and commercial sensitive information, etc., I wasn't entitled to have access to that data.
The logic for the 600% hike from Westpac's insurance arm, Allianz, didn't stack up for Michelle. She lives on the first floor of an inner-city Sydney apartment complex, and her building strata insurance had barely moved.
They said I'd consented to pay that increase because I was making automatic bank transactions. So I explained that I had set up the banking transactions because I worked overseas.
Hello, this is the Insurance Law Service. My name's Julia. How can I help you?
Michelle sought help from this legal centre, which is flooded with calls from people like her.
It's really impossible for consumer groups or even consumers to know if the price they are being charged is a fair price. The pricing algorithms that insurers use are commercial in confidence. It is a total black box.
Frustration over premium rises come as Australia's biggest insurers report bumper profits, thanks to years of premium increases and a relatively quiet year for natural disasters. Suncorp's profit jumped 52%, Insurance Australia Group 51% and QBE 27%. Great for shareholders, but market analysts warn affordability is a risk.
You've seen price increases well over probably 3 times the rate of wages growth of the last 3 to 5 years. You're also seeing people wind back the cover they have, and you're seeing then off the back of that more risk being retained by the individual.
In a recent report, the Consumer Watchdog confirmed premiums are climbing, with the average above $2,000. The ABC asked Allianz, QBE, Suncorp and IAG if they were price gouging. They all insisted premiums are based on risk. Consumer advocates, though, are calling for transparency. They want a national, permanent, industry-wide price monitor.
something the industry rejects.
We could employ hundreds of public servants to be looking at prices every day. I would rather see tax reform happen in this country. I would rather see money being invested in risk reduction so that homes are built in safe locations.
For consumers who want to challenge premium hikes, there is little recourse. The Australian Financial Complaints Authority has limited powers.
Most complaints about insurance premiums are not going to make it through AFCA. AFCA says it doesn't have jurisdiction to look at whether or not an insurer has given you an accurate premium.
That was the case for Ms Vanderlaan Smith when she took Allianz to AFCA. The complaints body refused to release the modelling the insurance used to justify the increase and ruled in its favour.
It gives me no confidence, actually. It makes me very cynical, probably, of all insurance companies.
Michelle was able to find a better deal for $1,000 a year, but she says the onus shouldn't be on consumers to avoid getting ripped off.
The flying kangaroo copped a hit to its reputation and its bottom line this week. Quantis has been hit with a record $90 million fine for illegally sacking workers during the COVID-19 pandemic. It's the largest penalty imposed by a court for violating Australia's industrial relations laws. David Taylor has the story.
It was the payday Don Dixon had been waiting for after being unlawfully sacked by Quantis in the pandemic.
We found out in the lunchroom over the loudspeaker.
How'd that make you feel?
Terrible.
Why?
Well, because it was just an insult, another insult.
Here it is, folks. It's all for us, Junior.
Today he got his day in court as the airline was slapped with a $90 million penalty.
I accept Qantas is sorry, but I'm unconvinced that this measure of regret is not, in a significant measure, a result of what the full court described in another case as the wrong kind of sorry.
This is the largest penalty handed down for a breach of industrial relations laws in 120 years.
At the height of COVID, Qantas announced it was outsourcing its entire ground handling crew, leaving 1,800 workers out of a job. A move the former Qantas boss defended.
Qantas at one point was just 11 weeks away from running out of cash.
But the federal court later ruled the workers had been sacked illegally and a $120 million fund was set up to compensate workers. Today's $90 million penalty is in addition to that fund. Of the $90 million penalty, $50 million will go to the Transport Workers Union, with the remaining $40 million expected to go to the 1,821 workers who lost their jobs. The union says it was never about the money.
What's important is that a strong signal has been sent to every employer in Australia.
Quantis claims that over the past 18 months it's worked hard to change the way it operates, saying, "This remains our highest priority as we work to earn back the trust we lost." The flying kangaroo left to bounce out of yet another crisis.
The boss of BHP has been on a strategic visit to the US this week as the country's biggest miner reported a solid full-year profit. It made $9.1 billion, up by 14% from the previous year, and shareholders will get a final dividend of 60 US cents a share. Mike Henry, along with his Rio Tinto counterparts, was at the White House to lobby Donald Trump on a US copper mine approval. Progress has been stalled by the courts blocking the US administration from handing over a sacred tribal site to the joint venture.
So it was disappointing to see that there was an administrative injunction put in place as parties sought to appeal some earlier court decisions. As to how long it takes for that to get resolved, not quite clear on that, but both Rio and ourselves are really ready to go and want to get activity underway on the ground.
Mike Henry may have found an ally in the US president who has posted on social media in favour of the copper mine. The share market touched a fresh record this week before the gains fizzled out on Friday. The ASX 200 was up 1/3% and the All Ords added 1/4. Kyle Rodder from Capital.com joined me at the end of the trading week. Kyle, there have been some huge reactions in share prices to the results announced this week. Why? What's going on?
Well, I mean, I think what's effectively happened here is that if you look at the movements, generally speaking, misses have been punished far more than hits have been rewarded. And I think the reason for that is that if we look at the overall market, we're at record highs. We're at valuations that, at the start of the year, we're at similar levels, and there were calls that were in sort of almost bubble-like or very frothy territory. So when companies have missed expectations, they've seen a significant snapback in their valuation to effectively reflect much more the company fundamentals rather than, other external factors to the business more influencing the share market. So, it's effectively a case of investors now being able to digest earnings that, sometimes have been okay, sometimes they've not been great at all, but are, certainly sobering up investors and making them focus on company fundamentals rather than other dynamics that have, inflated valuations.
CSL was one example this week which really was hammered and perhaps didn't deserve to be sold off quite as much.
It's an interesting one because I think a big factor there is obviously the announcement that they're going to spin off the virus segment. So one thing that investors have to do now with the existing stock price is reflect the fact that this company is going to be taken out of future cash flows and the assets are going to be stripped and taken somewhere else. So that has to be reflected, obviously, in the valuation of the stock. But, clearly as well, there are concerns there that, this once market darling is no more, that its earnings outlook is at risk, or at least the growth outlook is at risk. And of course, the business is confronting, fairly significant changes potentially in the, pharmaceutical and medical research and biomedical research industry, driven a lot by what's happening in the United States. And that's bringing a lot of uncertainty for the business and their subsequently shareholders, the outlook for future profitability. So, again, some of it's just a bit of a mechanical thing. Another thing is just, simply the fact that, again, the stock valuation was, reasonably rich, and, we've got a situation where the earnings outlook doesn't seem to really justify the price that it was trading at.
Well, to give a few more examples, we saw GYG at the end of the week sold off as much as 18%, while Zip went in the other direction, up 19%. Are these big swings broadly being exacerbated by the passive money floating around in the market?
There's a very strong argument that flows drive share prices, at least in the short to medium term, than fundamentals do. And, if you go back to what we were just talking about before around some of these big violent moves that we've seen in the market, flows trickle into some of these companies. They're driven by momentum and these other technical factors. And then when you get, company reports that, forces investors to actually look at the fundamentals of the company, prices react very violently then to reflect those fundamentals. What are some of the things that can influence it? Well, there's, yes, those passive flows that, effectively come from, maybe highly liquid markets, or the fact that, everyone's got relatively high incomes and they've got that money tipping into their super or their share trading accounts, every month. The other dynamic too is the boom in retail trading, and specifically, say, in the United States, zero-day option expiries, which compound this volatility and this sort of momentum factor in the market. So certainly, you could say that flows more than ever are driving price action, and then also causing eventually volatility when those flows disconnect from fundamentals.
Well, the Australian share market broke through 9,000 points this week when we look at the ASX 200 index. Where to from here?
Well, it's going to very much depend on the outlook for global monetary policy. And, arguably the reason why we saw the market higher this week, wasn't because of company earnings, which, as we've noted, have been, choppy at best, or, seen big swings at best. But what we did see on Wall Street and across the globe, which was a bit of a swing from growthier tech names, mostly in the artificial intelligence space, of course, in the United States, back towards more cyclical names. And of course, the ASX 200 has a lot of cyclical stocks. It's heavily weighted to those cyclical industries. So we hit that record high by virtue of that kind of strength. If you look at the Dow, for example, or even the Russell 2000 to a lesser extent, cyclical indices that held up better than their tech-heavy NASDAQ and S&P 500. And if you look at Chinese stocks as well, they hit a 10-year high, again, because of this rotation. If we get these rate cuts coming through in the future, that might support that rotation, that might push our market higher, but it very much depends on that kind of macroeconomic backdrop, which is, outside Australia, predominantly in the United States.
Kyle Rodder, thank you so much.
Thank you.
Putting a lamb roast on the table is coming at a premium price. The current cost of lamb is turning consumers toward cheaper meats. Recent drought conditions hit Australia's supply hard and led to new price records being set at the sale yards across the country. Jane McNaughton reports from Victoria's lamb country.
I hope you realise I gave up a dinner with Tom Cruise for this.
It's one of Australia's most popular Sunday roasts, but the price of lamb is on the up, and it might soon be hard to justify putting on the dinner table during a cost of living crisis.
The sale yard pricing of lamb nationally over the last year has gone up by about 32%. Retail pricing, the trend does follow the sale yard. It sometimes can be lagged, and over the last year, the retail price on average of lamb across the country has gone up 12%.
And the reason it's so expensive is the drought. With fewer lambs at the sale yards, prices have reached record levels, setting a challenge to supermarkets trying to keep prices down.
Legs of lamb at the moment are retailing at around $15.99 a kilo, but that leg is costing us close to $14. So that is very, very light margin on meat.
For local butchers like Justin Cashman, it's a losing battle. He can't compete with the supermarkets, which can offset the increased price of lamb over other parts of their massive supply chain.
We don't want a massive margin, but we obviously need a margin to stay in business. But when they have 5,000 different lines that aren't related to meat, they can afford to sell it below cost.
The price hikes for popular cuts of lamb has led to a 30% reduction in sales at the butcher, with people switching to cheaper cuts of meat like chicken and pork.
It's expensive and chicken is a lot cheaper, and we can buy good quality free-range chicken for a really good price, and so we opt for that now.
A wet summer has been forecast, but even if the drought breaks, the price of lamb is expected to remain high for some time.
We're going to keep paying more and more for lamb into the next few years just because of that tight supply and very strong offshore demand.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News Channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.